Most people think success in the stock market comes from picking the perfect stocks, timing the market perfectly, or constantly chasing the next big opportunity. But the truth is, one of the most powerful investing strategies has been available for decades, and most people still use it incorrectly. The problem isn't usually lack of information. It's emotional decision-making, impatience, inconsistency, and misunderstanding how long-term investing actually works. Today we will talk about the stock market strategy nobody uses correctly, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people think investing is about picking the perfect stock. When most people enter the stock market, they immediately focus on one thing: finding the next big winner. They search for the perfect stock, the hidden opportunity, or the company that will multiply their money quickly. Social media, news headlines, and financial influencers constantly reinforce this mindset by turning investing into a prediction game. But the reality is very different. The strategy that quietly builds the most wealth over time is not exciting, complicated, or fast. In fact, one of the most effective stock market strategies is something almost everyone knows about, but very few people actually use correctly. 9. Most investors treat the market emotionally instead of systematically. One of the biggest mistakes people make is investing emotionally. They buy when excitement is high and panic when fear appears. When markets rise, people suddenly feel confident and rush to invest more. When markets fall, fear takes over, and they stop investing completely or sell at losses. This creates a cycle where people accidentally buy high and sell low, the exact opposite of how wealth is built. The stock market rewards systems far more than emotions. Long-term investors understand that markets naturally move up and down. Instead of reacting emotionally to every crash or rally, they follow structured investing habits regardless of short-term conditions. 8. Dollar cost averaging sounds boring, but it's extremely powerful. One of the most underestimated investment strategies is dollar cost averaging. This means investing a fixed amount of money consistently over time regardless of market conditions. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over long periods, this smooths out emotional decision-making and reduces the pressure of trying to perfectly time the market. The reason most people fail to use this strategy correctly is because it feels slow. People want dramatic returns quickly, but real wealth in investing is often built quietly through repetition, patience, and long-term compounding. 7. Most people stop investing at the worst possible time. Market crashes scare people emotionally because losses feel personal. When portfolios drop, many investors suddenly abandon their strategy entirely. But historically, some of the best long-term buying opportunities happened during periods when fear was highest. The problem is psychological. People intellectually understand that markets recover over time, but emotionally they struggle to continue investing when uncertainty rises. This is why consistency matters more than confidence. Successful investors do not invest only when they feel comfortable. They invest according to systems designed to continue working even during fear and volatility. 6. Time matters more than timing. Many beginners obsess over timing the market perfectly. They wait for the perfect entry point or try predicting short-term movements. But even professional investors struggle to consistently predict markets accurately. What actually matters most is time in the market. The longer money remains invested inside growing assets, the more compounding can work. Missing even a handful of strong market recovery days can dramatically reduce long-term returns. 5. Compounding looks weak at first, then becomes massive. One reason people misuse investing strategies is because compounding feels invisible in the beginning. Early gains often seem small compared to effort or patience required. This causes people to quit too early. But compounding is not linear. It accelerates over time. Small, consistent investments made over decades can eventually grow into surprisingly large amounts because returns begin generating additional returns continuously. 4. Most investors focus too much on short-term news. Financial media is designed around attention. Headlines constantly create urgency, market crashes, economic fears, political uncertainty, inflation, interest rates, and stock predictions dominate daily coverage. But long-term wealth is rarely built through reacting to daily headlines. Constant news consumption often increases emotional investing behavior because people begin treating every short-term movement as a major event. Experienced investors understand something important. The market's short-term behavior is noisy, but long-term growth historically comes from staying invested through uncertainty, rather than constantly reacting to it. 3. Diversification protects people from their own overconfidence. Another strategy people misuse is diversification. Many investors become overly concentrated in a few stocks because they believe they found the next big opportunity. While concentrated investing can create large gains, it also creates enormous risk. Diversification exists because nobody predicts the future perfectly. Spreading investments across industries, sectors, or index funds reduces the damage one bad decision can create. Ironically, diversification often feels less exciting emotionally because it reduces dramatic wins. But it also reduces catastrophic losses, which is one reason long-term investors rely on it heavily. 2. Investing works best when it becomes automatic. The investors who often build the most wealth are not necessarily the smartest. They are the most consistent. Automated investing systems remove emotion from decision-making. Contributions happen monthly regardless of fear, headlines, or market noise. This transforms investing from an emotional event into a long-term process. Instead of constantly deciding when to invest, the system continues automatically. The stock market rewards disciplined repetition far more than occasional bursts of enthusiasm. 1. The real stock market strategy nobody uses correctly. Long-term consistency without emotional interruption. The deeper truth about investing is that most people already know the basic strategy that works. Invest consistently, stay diversified, think long-term, and allow compounding to work over time. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.